Dear viewers, welcome to Fundamentals, a platform to understand your fund tenets. Here we bring to you the mind behind your funds. So let me start today's episode with a question. Is equity the only way to create sustainable long-term wealth? The answer is surprisingly no. If I look at last 25 years and if I compare sovereign bond index with Nifty 50, there is hardly any difference of return. As you would have guessed by now, we come to you with yet another episode on fixed income. Our focus today would be actively managed fixed income funds. Our guest for the day is one of the most respected minds in this space. We have with us Mr. Suyash Choudhary, Head Fixed Income, IDFC Mutual Fund. Hi Suyash, many thanks for joining in.
Thank you so much for the invite, Harsh. Look forward to this conversation.
So Suyash, my first question is very basic in terms of understanding what is your investment style and approach to investing.
Look, so, when we think about a fixed income platform, there are a few things that one needs to clearly define. One is a sort of a philosophy that is a bit of a guiding light for how you conduct investing. And the other is that as far as possible, you should be able to very appropriately and clearly position the risk profile of various products, which enables asset allocating investors to pick and choose the right product basis their investment horizon and risk profile. Now, as far as philosophy is concerned, for the longest time, what we have thought is that because we are a mutual fund, which is basically a pass-through vehicle. You get money, you invest that money on behalf of the investor asks for the money back, you sell what you have bought and you return the money. In essence, that is what a mutual fund vehicle is. And therefore, you take risks that are manageable. So, we have been associated with being very conservative on credit risk as an example. Now, why that conservatism? Also because credit risk inherently in India so far has been difficult to liquidate, right? So for example, interest rate views you can get right or wrong, but in all probability, you will be able to liquidate what you have bought. Many times historically, we have seen that in the case of credit risk, once there is credit deterioration or sometimes even without it, credit risk sometimes becomes hard to get out of. And which is why we have been conservative on credit risk, because the overarching philosophy is that you should be able to take manageable risk, also given the nature of the platform where liquidity in what you buy is of essence. So in a sense, that defines our philosophy that most of what you buy, you should be able to sell. The second pillar of the fixed income positioning is how you position products on a risk profile. So again, we have been doing this, the way we classify our products in liquidity, core and satellite buckets is basically meant to give a very clear idea that if you're an asset allocator into fixed income with a certain risk profile, how do our products fit in these various buckets? So liquidity is largely for your cash management needs. The core bucket of products is where, to the best of our abilities, we take constrained amount of duration and credit risk. And the satellite bucket of products are those where, depending upon our views, we can take higher amount of duration or credit risk, or in some cases, both. Right? So the mandate in those products allows for higher duration or credit risk. By doing this, like I said, hopefully we facilitate better asset allocation choices from investors. And to us as fund managers, it provides an additional layer of discipline when we run our products. So, when we think about products in the core bucket, we are very cognizant that to the best of our abilities, we have to manage risk very tightly. So the duration and credit risk has to be relatively more constrained, of course, within the definitions of the fund. And in the satellite bucket, we can potentially take higher amounts of these risks. So that basically, defines how we run fixed income. It's not necessarily a limited approach only around pro or anti-credit. If credit provides enough liquidity, and if it's done in the right bucket of products, we think, that also is a risk as long as it's manageable that one could do. The only thing that we have historically tried not to do is, in some sense, commingle a lot of risk across products, which is why the core satellite philosophy is what we stand by.
Thanks, Yash. You mentioned a few very, very interesting points, and I would discuss those one by one. So the first thing and the most important thing which you mentioned was core satellite and asset allocation. And generally, we don't see fixed income managers talking about asset allocation approach. Now, what you were mentioning was with respect to the fund house and your philosophy. But how does an investor take that philosophy of asset allocation in fixed income for his or her allocation? If you could help understand that.
Look, one has to start from the basics. One has to identify what are the risks in fixed income. It is largely interest rate risk, credit risk, and to some extent, liquidity risk. However, we find that sometimes the conversation on fixed income becomes unnecessarily complicated, right? And you find so many people saying that we understand equities, but we don't understand fixed income. And that's a very, very surprising statement, because fixed income, when done rightly, is largely about carry income, right? And therefore, as long as you understand the risk profile of the product, and as long as the fund manager has the discipline to run the product in a certain risk definition, and you come with an appropriate time horizon, it's relatively easier to allocate to fixed income, I would say. So let's just take this liquidity core satellite in context of asset allocation. So liquidity is for your cash management needs. Typically, you will have overnight liquid funds, etc. there. So let's keep that outside of the investment bucket. The investment bucket is really core and satellite. Now, most fixed income investors come to fixed income because they are conservative. They want income, right? They are not looking for drama. They are looking for income. And therefore, I would think most of fixed income allocations therefore have to be in the core bucket of products, where the fund manager should be able to take only constrained amount of duration and credit risk, right? And there you could have a host of products, but it's not always the product definition that is the best representation of the product, but also the product strategy, the philosophy, etc. Right? So, you could potentially think about your money market, ultra short term, low duration, short term, medium term kind of products in the core category, or maybe up to short term, depending upon how you're running. And in the satellite bucket, you could have active interest rate products like dynamic bond fund, like gilt products, as well as credit risk funds, or funds that are derived out of credit risk. Then you basically think about what is how conservative are you? So if you're a traditional fixed income investor and very conservative, you put 80%, let's say, as an example, in the core bucket and 20% in the satellite bucket, right? And then you sit on it. So if you see the history of fixed income allocation over the last 7-8 years, we have found that it tends to be very almost thematic. So you find, at the height of a interest rate bull run, there is a lot of interest that comes into dynamic bond funds and government bond funds. And then when the cycle reverses and the experience is bad, then people tend to exit at that point in time. You'll find that over a 3-year, 5-year rolling return, the experience in a dynamic or a well-run dynamic or a gilt fund could be very different from what you experience if you take very short cycle views basis momentum. Right. Similarly, there was a tendency over the last 5 years to over-allocate, or not the last 5 years, the period ending 2020, to over-allocate into credit risk funds. Right. So credit risk funds, dynamic bond funds, gilt funds, which are all taking higher amount of risk, be it interest rate risk or credit risk, belong in the satellite bucket. And if you're a conservative fixed income investor, you may not want to put, let's say, more than 20% in that bucket. The advantage of that is because you have constrained the allocation to that bucket, it affords you the luxury to ride it for longer periods of time. So even if you have a negative shock there, it doesn't wipe you out, right? It's 20% of your allocation, and therefore you can give time for, let's say, if a dynamic bond fund experiences an interest rate shock, a time for it to come back. Or for example, a credit risk fund that experiences a negative event, a time for it to come back, whereas 80% of your fixed income is core. Now within core, you could define, so if you have a 6-month investment horizon, you could potentially choose a money market fund. If you have a 2-year investment horizon, you could potentially choose a short-term bond fund. So basically this core satellite bucket intersects at your risk appetite and your time horizon. So this other myth that many times in fixed income we have is that if you have a longer time horizon, necessarily you should buy a riskier product. No, you may have a 3-year time horizon and you may very well choose to buy let's say a money market or a short-term bond fund, because this is your 3-year allocation, but in the core bucket. Right. So we also have to, make this distinction that just because you have a higher time horizon does not necessarily mean that you should always choose a riskier product. Although if you're buying the riskier product, then you better have a longer time horizon. Right. So that's how we would approach, asset allocation in fixed income.
Got it, Suyash. And again, very interesting point on 2-3 parameters, and I'll just come to each of them one by one. Now, first point, you discussed about credit risk, liquidity. Now, if I see investor behavior for last few years, when we look at equity mutual funds and the flows which are coming there, and anecdotally also when we speak to a lot of investors, we feel that many investors are going beyond their risk profile, and that's how things have been panning out in that space. But when it comes to fixed income, we see both investors as well as fund managers. And you mentioned ending 2020, there was a lot of credit risk which was built into the portfolio. But now we are seeing a trend opposite of that, where both fund manager and investor, they want to over allocate in AAA, CPSC, SDL, GSEC, etc. Now, is it the same with you? And do you think fixed income market is again getting polarized in favor of extreme safety than what it was in 2020 when it was moving toward extreme risk?
So, I would answer this one from an asset allocation standpoint, then two as a, let's say an active discussion on the fixed income market standpoint. See, from an asset allocation standpoint, remember, as a working example, not a recommendation, just as a working example, we said that for a conservative fixed income investor, probably 80% in core and 20% in satellite makes sense. Now, as per definition, the bulk of core products would be running low credit risk. So they would typically be investing in many of the things that you just mentioned, right? Now, if you are, let's say, bullish credit risk, you would tweak this on the margin. Let's say go to 75-25. If you were bearish or conservative credit risk, you would go to 85-15 or 90-10. But the tendency we have seen in the marketplace is that you go whole hog into one idea at one point in time. And that is what I am pushing back against. So even from an asset allocation standpoint, the observation that we are, now fully into conservative, you said AAA, SDL, etc., is probably irrelevant, because any which ways 80% should be there, right? However, now coming to looking at this more dynamically, see, where the situation on credit risk was 3 years back, where credit was almost a macro top-down risk, because there were a lot of balance sheets in the system that were potentially carrying a lot of risk. From there, we have now moved to a situation where bulk of this risk at a macro level is cleaned out. So you are now seeing very strong balance sheets, very large balance sheets, both in the financial sector and the corporate sector have cleaned up. And we don't think about credit as a top-down risk to that extent anymore. However, the problem today is different. The spread that you are getting for taking on credit risk is abysmally low, right? So you are hardly getting 50-75 basis points additional spread for taking on credit risk. So even though the narrative on that would have improved and improved substantially, unfortunately, the pricing has eaten away most of whatever you would have made by taking on this additional risk, right? So we believe that at this juncture, actually, in fact, even if you have a positive view on the balance sheet, you have to be very clear what price or what yield advantage you are getting or what spread you are getting versus the risk-free or the sovereign rate. And at this point in time, those spreads are abysmally low. So our view remains that this is the phase in the market where actually you should be running more of sovereign. That doesn't necessarily mean long duration sovereign. In fact, our stated views are that we like government bonds up to 4-5 years only, rather than taking on too much of credit risk, which is not paying you enough spread.
This is very interesting. And now coming to the 80% core portfolio that you have discussed in last 2 to 3 questions. What we have seen is that there is a tendency among retail investors as well as institutional investors in last couple of years to opt for passive and target maturity fund in this space. Now, you have been managing a huge book on passive funds as well, but we know you and we track you more as an active fund manager. So what do you make of this trend at this point of time?
We think this is a very healthy trend in a sense that it probably finally allows investors to, come into fixed income products with a greater degree of continuing confidence. If you see, a lot of history of, and I don't mean to generalize, but a lot of history of fixed income in India, from time to time, investor confidence has been damaged, one by failure of alpha, but two also because of wrong allocation behavior, which we just discussed in detail, right? So the allocation behavior is actually something which has to be, managed at the advisor investor level. But there has been, and which is natural, failure of alpha from time to time, which basically means, your market reading went wrong. Now in duration products, you had, because interest rate risk can be liquidated, in a more seamless fashion, you could get out of it. In some of the credit risk funds where that alpha went wrong, you just could not get out of it, which is the nature of that part of the market. So, this index or roll down or passive products have to be an integral part of the market. And we are very much, on board, supportive and actively participating in the idea of passives, because it does give a reasonably low cost option to investors with reasonable visibility, as long as, you are for the life of the product invested in the product. However, just like with everything, you should have a reasonable sense of the pros as well as the cons. And one of the downsides of being fully invested in a passive product, as an example, is that a passive product will not or will probably subject you to reinvestment risk. So how would that work? Let's say, you are fully invested in a 5-year passive index product and you have a 5-year investment horizon. So far, so good. So you are in a sense matching your investment horizon with the life time of the product, and therefore you don't care about intermittent volatility in the marketplace because of this matching. However, you don't know what the rate environment will be 5 years from now when your money matures. So suppose, hypothetically speaking, this is just an illustrative example. Today, a 5-year is at 7%. Hypothetically, let's say 5 years from now, it is at 5%. And that is when your investment is maturing. So at that point in time, you would be subject to reinvestment risk. Because, when that money matures, you'll be looking for fresh avenues, and interest rates then are at 5%. So which is why in the in the core bucket itself, you could potentially choose a combination of, as an example, index products as well as traditional short-term products. The short-term products advantage being that it will not subject you to reinvestment risk, because the portfolio manager will be continually rebalancing maturity of the product as time passes. However, the advantage of the index would still remain that, you have greater visibility because it's a roll down kind of product. So there is space for both. There is even space for more actively run funds in the satellite bucket, as long as we start from a place where we have a robust asset allocation table, so that we know where to fit what, and we are aware of what kind of risks are we taking and what kind of risks are we mitigating by being investors in whichever category of product we are putting money.
Now, my next question is again, some part of it has already been answered by you. When we interact with our investors, they have some sort of a mental checklist with respect to investing into equity or equity mutual funds. But when it comes to fixed income, though you mentioned in one of your answers that it's a very simple category to understand, investors don't have much idea other than their liquidity need, which they have some clarity about. Now, being a seasoned person, would you please help us understand from an investor point of view, what are the broader variables which one should keep in mind while investing in this category?
So, one way to approach this question is to answer from market variables, right? Like growth, inflation, fiscal deficit, current account deficit, etc. However, my suspicion would be that many of investors would rather, want to know how to approach as a consumer, right? And see, one of the things is that, and especially I feel with the proliferation of social media, we tend to be very topical about our investment themes. As an example, over the last 1.5 years, this category of floating rate funds caught a lot of investor attention, right? And the premise on the face of it was simple: interest rates are rising, therefore floating rate funds will do better. If you go back and check when interest rates have risen by 200 basis points, how floating rate funds have done, you will be surprised, right? So there are, one of two ways we can adopt. Either we keep this simple, or if we are getting into more complicated topical themes, then it's our duty to understand how the product is constructed. So therefore the back end as well. So the danger is that we apply simplicity across the board. So the danger in this case was that, interest rates are rising, so floating rate will do better. You can't intuitively argue against that. So lots of money flowed into floating rate funds. The product class did not do well. And I, probably this is not the forum to get into why it did not do well. But, in our case, we were, sounding warnings on, why this was not that good an idea. But that being said, nobody bothered to go behind the scenes to see how these funds behave and what kind of instruments are being bought into the fund and how will the instrument behave in various scenarios. So therefore, if you don't want to get into that complication, keep it simple, right? And the simple aspects are that, there are certain almost truths of fixed income investing that, the kind of risks that you take are credit risk, interest rate risk, and liquidity risk. Now I can twist and turn it to, make it sound in a particular way. However, these are the simple aspects of fixed income investing. Then keep it simple. So for example, if 80% needs to go to a core bucket, I may need some money in 6 months, I may need some in 12 months, or my investment horizon could be 6, 12, 24, 36, etc. I split this into, money market, short term, index, maybe a bit of some medium term as well. And in the satellite bucket, I look at active managed bond products, gilt products, and maybe some credit risk if that is my appetite. And at an allocation level, I control what exposure to each one of these. Last point there I would make is, and this is where we have to go actually behind the scenes, there's a lot of homogenization that is underway, uniformity that is underway because of a series of very positive changes that the regulator has brought in. So, the PRC, the risk class matrix, the definition of each fund category as to what they can and cannot run. However, even within this, there are large differences probably still between two sets of strategy within the same category. As an example, a medium-term fund could be very low on credit risk, or a medium-term fund could be very high on credit risk, right? So you have to therefore be in touch with your asset management company to see what is the strategy within that fund class that they're running and how durable is their thinking or philosophy behind continuing to run a strategy like that. So many times, what we saw in the aftermath of the credit crisis is that many people pivoted to a very quality portfolio, but that was almost tactical, right? And that doesn't help you, because remember, if you are 80% allocated to a core bucket and you picked one product there that you thought is low on credit risk, and that product suddenly increases credit risk at some point in time, then in your asset allocation table, that's a violation, right? So it goes from being a core bucket product to a satellite bucket product, and that you should gatekeep very, very strongly. So if at all, a large part of the advisory function discussion that needs to happen there is, how can we safeguard or gatekeep these various buckets of product, and also, in some sense, be in conversation with the asset management companies to say that, if this is a core bucket product, the likelihood that it continues to run as a core bucket product.
Got it, Suyash. And that brings me to the next question. You mentioned about the simplicity of investing into fixed income, and you defined it on the basis of asset allocation, liquidity requirement. But should an investor bother about things like market cycles, like expansion of economy, contraction, rates going up, rates going down? So, A, should investors be bothered about it? If yes, how should they plan about these things?
See, many times, or sometimes, not many times, sometimes you get into, the extreme phases in the market where a large, macroeconomic event has happened, and therefore there are large shifts in the marketplace. And the last 2 years was something about that. So in that scenario, you have to be aware of what's going on, and therefore, asset allocate accordingly. But, to a very large extent, the fund manager would also be ensuring right asset allocation, but there are certain nuances in play. I'm just taking the example of the last 2 years. This may not always hold true. Now, you will recall that, so first of all, one simple concept, that of an yield curve, right? So in fixed income, we talk about an yield curve, which is nothing but the price of money for various tenures. So there is a price of money for overnight, which is where effectively the RBI effective overnight rate is. There's a price of money for 3 months, 6 months, 1 year, 2 year, 5 year, 10 year, and so forth. Now, this yield curve used to be reasonably flat a few years back, which meant that the price of money at the overnight point to the price of money at the 10-year point, the difference between the two was less than 1%. Our sense is a lot of mindset was still pegged to that era or that time when the curve was very flat. And people probably failed to take into account that, especially in the post-COVID phase, the yield curve became very steep. So as an example, roughly speaking, the overnight rate was something around 3/4 to 3/2, whereas the 5-year government bond was sitting at very close to 5.75 to 6%. So the yield curve suddenly became very steep. Now, how you think about investing and asset allocation in that environment then changes, because we found a lot of advisory saying that we are conservative on interest rates, so therefore go and sit in a money market fund, which is what traditionally you would have suggested in a flat yield curve environment. But in a steep yield curve environment, when you went and sat in a money market fund, you were most exposed to the overnight rate changing, because the money market fund would be pricing off the overnight rate, which was artificially low. Our suggestion was that you should instead look to barbell. What was barbelling? Barbelling would have been that instead of taking risk in the money market segment, which could have blown out as RBI raised interest rates, and in fact that happened. So just to give you an example, a 1-year treasury bill, which was roughly in the area of 3.5%, is now at 6.3%. So roughly a 200 basis point rise has happened even in the money market space. So our view was that instead of this, you benefit from the steepness of the curve by holding cash, which is an overnight fund, and then holding 4-year, 5-year in a ratio that is consistent with the average maturity that you want to run. So in that case, what would have happened, that the 4 and 5-year allocation would have bled lesser. The yields on that would have gone lesser up because it was already quite steep. And the overnight allocation would have changed without giving you any mark to market loss because it was just overnight. So had you cleaned out your money market bucket in favor of a strategy like this, it probably would have worked better than what your experience on hindsight has been over the last 1.5 years, right? Barring this, in most cases, probably a traditional asset allocation table would hold. Going forward from here as well, we think a traditional asset allocation table should hold because in the example that I just gave, even money market rates now have significantly repriced. So, a 1-year bank CD is, roughly in the vicinity of 670 to 675. 1-year treasury bill, like I mentioned, is in the vicinity of 6.3%. So the point I'm making is, especially given our view that the repo rate in this cycle probably peaks around 6%, the money market curve has also done a lot of the repricing that it needed to do. And now you can revert to the traditional, fixed income way of thinking, which is core and satellite. And, you have a range of money market, short term, etc. going for you. But you had to interrupt this for the last 1.5 years if you saw how the yield curve had changed in the post-pandemic phase.
Got it. Perfectly understood. And for the reference of our investors who are watching this, I would say that you can follow Suyash on his LinkedIn post as well as circulations done by IDFC. Whatever he's mentioning is very consistent with what he has been saying for the last 2 years. Suyash, one interesting observation we have with respect to your fund house, and we should give you compliment for that, is that you haven't had any bad episodes or accidents in last 3 to 4 years, while a lot of peer group was undergoing a lot of stress, both at a fund level as well as a fund house level. So we do understand credit is a two-way approach where there is the ability as well as the willingness of investing company to pay. While some people went wrong on judging ability, some went wrong on willingness. So how do you ensure that your investee companies are stable on credit and they have willingness to pay back what they are intended to?
So, first of all, like I said, a large part of, how we fared over the last 2 or 3 years was also, basis our philosophy on how to run these risks. So, one of the things that we discussed at the start of this conversation was that a lot of the credit market just freezes when negative event strikes, and which is probably some bit of that is not conducive to being run in an open-ended fixed income mutual fund platform, right? Having said that, it does not mean that you can't do credit in a fixed income mutual fund platform. And we ourselves have explored in the past and will probably explore in the future how it can be done in a way that is within a product class, which is well defined to the investor that this product class is equipped to take more credit risk, and within that to take as much of it to the largest extent that we find we can liquidate. Now moving on to how we monitor. So the bulk of the credits that we run are what you could call a liquid credits. So they are the large public sector or large private sector companies of India. And then there are some which are smaller balance sheets. But so, apart from your normal considerations of business profile, financial profile, leadership in the industry, entry barriers to the business, etc., you also pay close attention to management. You look for, auditor qualifications as an example. You look for board churns. So if board is churning quite frequently, etc. So, you have a set of red flags that you are actively monitoring for. And then, that's how you largely proceed on the credits that you hold. So there is a very, very large aspect of monitoring. So even our stated, philosophy of historically being relatively conservative, we still have a reasonably large size credit team. Compared to the total number of people we have in fixed income, who is continually evaluating what we hold, who is thinking about what else can be done within the framework of our core satellite bucketing. But a lot of this, goes into it. So very, very detailed reading and, listening to management commentaries, auditor observations, rating rationales, industry feedback on the company, etc.
A lot of interesting points, and I'm really sorry that we don't have time to discuss all those points. Maybe in the next few episodes we would try to get hold of you again and ask you some pointers which you gave today. So that brings us to the last question of our conversation. You have given us a lot of perspective on fixed income landscape in India, plus on how the market is looking like at this point of time. But we would want to know a lot about, or a bit about, your fund house as well. So you mentioned about team, you mentioned about your credit team. So you are the face of the fund house, but if you could help us understand what is the scene behind the curtain, which help you in terms of understanding and in terms of research that helps you take decision with respect to what you do.
Let me clarify first of all, I am the face in a sense that probably I'm the most visible, but let me assure you that there are fund managers on our platform who are running more assets than I am running, and they are running them independently within the framework of investing that I just defined. We are currently a team of 8 people. We were 9. Our one resource in credit has moved out, which we are in the process of replacement. So on a steady state basis, which is when we are a 9-member team. So I'm obviously heading fixed income as well as running some of the funds on the active duration side, as well as 1 or 2, let's say a short-term bond fund. I have 3 fund managers with me currently, who are running, all our money market funds, all the passive funds, including the corporate bond fund, banking PSU, as well as yield constant maturity. So these responsibilities are distributed amongst these 3 fund managers. I have 1 dedicated dealer on desk. But dealing is something that all of us can do in fixed income. So unlike equities, it's not completely segregated. Then I have 1 dedicated economist for the fixed income team. So the economist's job is to basically track local, global data to build on our own in-house research on macro, on forecasting data, etc. And I have 3 members ordinarily in the credit team, currently at 2, but 1 who recently moved on for personal reasons, actually moved abroad, and we are in the process of recruiting. So currently at 8, but at a steady state, we'll be 9. And, this is largely the split. So 4 fund managers, including myself, 1 dedicated dealer, 1 economist, and 3 credit research people, including 1 head of credit, which will be the full team when we are there.
That's a very, very strong team. And now we know the reasons for the performance of your funds and avoiding all kinds of accident over last 3-4 years. Suyash, this brings us to the end of our conversation. And I must say, this has been a very interesting conversation in a very, very so-called boring subject, because many of our investors say that, we can't understand fixed income because it's not our cup of tea. But I think with your inputs, they can also try to understand it in a very, very easy and lucid way. I must say that this was more like a fixed income 101 for us also, because there were a lot of concepts at our end which got cleared with your inputs. Thank you so much for taking out time today on a Friday evening and helping our investor understand the nuances of fixed income. I'm sure we and our investor have a lot to carry from this, and we would have learned a lot by the end of this conversation. Thank you so much.
Thank you so much, Harsh. Absolute pleasure, and look forward to doing this again. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.